Hello and welcome to the Frontier Views webinar on the outlook for Southeast Asia. I'm Yuchen Han, a Client Service Associate at Frontier View in Asia Pacific. Before we get started, we realize that some of you may be new to Frontier View, so we would like to take a minute to provide you a very quick overview of our firm and how we work with executives at major multinationals. So Frontier View provides the world's best market intelligence and advisory services for global business professionals. We help our clients grow and win in their most important markets by informing, empowering market monitoring, planning, execution, and other critical decision processes of our clients. By continuous research and insights, custom solution, and transaction support services, we provide our clients with a very small sample of which you can see here with timely, actionable insights to adapt and win in changing markets. If you're not a client and are interested in receiving complimentary access to our Frontierview program, please leave a comment in the chat box or email us at info@darkerfrontier.com. As part of our offering, we are excited to announce that we have recently launched a new mobile app, Frontierview Mobile, which is available on both iOS and Android, includes all relevant contents you need to monitor markets, including this webinar recording and presentation deck. We encourage you to download the app to have access to insights and more at your fingertips. So if you are a current client, you can access the mobile app by using the same login information as our browser application. If you are not a client, you can still download the app and start monitoring up to 5 complementary countries and access other features like the daily news and notifications. So having briefly introduced our company, I would like to take a moment to introduce our presenter. So today's call will be led by Ashu Agarwal. He is a senior analyst for Southeast Asia and will be presenting the outlook for the 5 key emerging markets in ASEAN, highlighting key trends, opportunities, and risks in the region. As Ashu is constantly in contact with our clients, he will be discussing not only the results of our research, but also what we have been hearing from multinationals who are being impacted by the coronavirus. If there's any insights you see today as part of the discussion or any questions we don't get to answer, our client service team consists of Sarah, Ravin, Althea, and myself. We'll be happy to follow up with you directly. And with that, I would like to turn things over now to Ashu to take us through the agenda.
Great. Thank you, Yuchen. For the session today, we have split the session into 3 sections. The first section is going to be our ASEAN regional outlook, in which we'll be talking about the region as a whole and also comparing different Southeast Asian countries against each other. The second section is going to be country-specific outlooks, in which we'll highlight some of the more unique trends that are taking place within each of these countries. And the final section is a brief Q&A session where we'll allow the audience to pose questions so that we can provide any insight that we have available on them. So starting off with our first section on the ASEAN regional outlook. At this point in time, almost every conversation begins with an update on the COVID-19 situation in the ASEAN countries. And so what we have here is the active COVID-19 case numbers across the 5 key emerging markets in Southeast Asia, averaged out on a 7-day basis. What you'll see here is that we can broadly categorize the countries in Southeast Asia into 2 categories. In one category, we have Indonesia and the Philippines, where the number of cases are continuously rising. And they do not seem to be in a position where the number of cases seem to be flattening out. And so what we expect in those countries is for the number of cases to be on an uptrend as government policies are beginning to shift in a direction where health risks are expected to continue rising. And we'll see a little bit of that and some of those government measures in just the upcoming few slides. In the other category, we have Malaysia, Thailand, and Vietnam. In these countries, the number of overall COVID-19 cases have been relatively much lower, and the governments in these countries have been a lot more effective in containing the virus. And as a result, what you can see is that you can barely see the lines of some of those countries here at the bottom of the chart. But what you can start seeing right at the end of that chart at the bottom is an increase in the number of cases in Malaysia. And so if we remove the Philippines, and Indonesia from the previous chart and focus on the remaining three countries, what you can see here clearly is Malaysia is experiencing a second wave of outbreaks. This outbreak really began as a result of an election that took place in the state of Sabah. And hence, at this point in time, the majority of the cases are concentrated in the state of Sabah in eastern Malaysia. And that concentration includes a concentration of new cases as well as a concentration of active cases at this point in time. Now, while the overall number of cases is relatively lower in mainland Malaysia, which tends to be the most major market for most multinational companies, they have started reporting certain cases because of travel between eastern Malaysia and mainland Malaysia. As a result, as we'll see on the next slide, the Malaysian government has started increasing its lockdown restrictions and started implementing some lockdown restrictions in certain parts of mainland Malaysia, such as Kuala Lumpur, Selangor, Putrajaya, and to a certain extent, even in Johor. As a result of these COVID-19 cases, both during the supposed peak of the cases in Q2, as well as the future outbreaks that are taking place in several of these countries, governments across Southeast Asia implemented some pretty strict lockdown restrictions. And so what we have on the chart here or on the page here is the stringency index, which measures the containment measures across countries globally. And it provides the containment measures, or it gives the containment measures a quantitative figure. And it does it in a way such that you can track how containment measures have changed over time and also how they compare against other countries. And so the main countries that we're focusing on here are the 5 key emerging markets in Southeast Asia. And there are a number of things that you'll note from this chart. One is that at this point in time, almost every single country has weaker lockdown restrictions compared to the peak in Q2. And this is something that we expect to continue going forward. We expect lockdown restrictions to not go back to the levels that we saw previously. We also expect lockdown restrictions to be more targeted, where they'll be more specific to smaller geographic areas rather than have nationwide or large-scale lockdown restrictions such as the ones we saw in Malaysia and the Philippines in the second quarter of the year. And so and another major thing that you'll also notice is that a lot of countries have had some ups and downs in lockdown restrictions. So very clearly in the case of Vietnam, for example, more recently in the case of Indonesia, and most recently in the case of Malaysia, where governments have reimposed some lockdown restrictions after easing them. And this is also something that we expect to continue going forward. As various different countries open up their economies further, they're likely to experience second wave of outbreaks. And as a result, they will have to implement some targeted lockdown measures. And so we can expect some of those ups and downs to take place. However, just to reiterate, what we still expect is for overall lockdown restrictions to remain weaker than previously seen in Q2. What's important in this case is that most governments are likely to react very quickly when they see second wave of outbreaks come in, particularly in the case of Malaysia, Thailand, and Vietnam, where we have seen that the government has the willingness and the ability to react relatively faster. And so in that case, since measures could be implemented very quickly, it is important for companies to be resilient, for local teams to be resilient and be prepared for any increase in lockdown restrictions so that it does not impact business activity and it does not impact any logistics of your products in those specific countries. Now, as a result of these lockdown restrictions, as well as the changing patterns in COVID-19 cases, we've had to make very significant revisions to our GDP growth numbers. What we are highlighting here is our most recent forecast for 2020 and 2021 in the 5 emerging markets of Southeast Asia. What we expect is the largest in 2020, we expect Philippines to experience the largest negative impact from the COVID-19 outbreaks. And that's due to a variety of reasons. And but which are ultimately linked to the very strict lockdowns that the Philippines implemented, as well as the fact that they're seeing one of the largest outbreaks in Southeast Asia, even now, despite having implemented those strict lockdowns. All of this has had a very significant impact on business sentiment, consumer sentiment, any debt levels. And as a result, that we expect to continue to weigh down on overall economic growth levels in 2020. The country that we expect to be relatively best positioned in Southeast Asia is Vietnam, where we see a strong growth of 2.3%, making it one of the only economies in Southeast Asia to experience positive growth during the year. And this is largely because the government has been very effective in containing the COVID-19 situation in the country. And this has allowed a lot of business activity to resume, to continue operations. And this combined with the fact that it is attracting increasing levels of investment at this point in time, even despite the COVID-19 pandemic, and we'll go deeper into that when we talk about Vietnam specifically. But there are a number of positive drivers that are taking place in Vietnam that is allowing it to recover a lot faster and for it to continue maintaining positive growth during the year. Now, while looking at the absolute annual GDP growth numbers can be valuable, what we really want to highlight here is how we expect recovery of these different economies to be across Southeast Asia. And so what we have in the chart here is we have set the pre-COVID economic level, that is economic level or economic outputs experienced in Q4 2019 by these different countries at a level of 100. And then we have charted out the recovery across these 5 Southeast Asian countries in a way such that you can see when each of these economies is expected to cross pre-COVID levels, or if they're expected to cross pre-COVID levels before the fourth quarter of next year. What you'll notice here is that we expect a very fast recovery in the case of Vietnam, where we estimate where we already know, given that Vietnam has released its third quarter numbers by now, is that Vietnam has already recovered to pre-COVID levels at this point in time. The next country which we expect to recover the fastest is Malaysia, because of its relatively strong containment of COVID-19, because of its strong management of overall COVID-19 situation, and also because of strong government support, which is likely to provide or prevent any structural damage to the economy, and which will allow the country to recover overall relatively faster. The other countries, such as Indonesia, Philippines, and Thailand, are expected to recover much slower, where we expect recovery to pre-COVID levels to go beyond the fourth quarter of 2021. Particularly in the case of the Philippines and Thailand, this impact is likely to be even larger, where in the case of Thailand, tourism is going to be a major drag on overall economic recovery. And in the case of the Philippines, significant structural damage caused to the economy because of the large and continuously growing COVID-19 cases and lockdown restrictions will limit economic growth both this year and also to a very large extent next year. Now, while we have been really focusing on the broader economic outlook, what we also want to do is to look slightly deeper into some of the more consumer and manufacturing activities and trends in those activities at this point in time. What we have here is the retail sales growth in the 4 Southeast Asian countries. We do not have data for the Philippines available, but largely to a certain extent, the trend is similar, where we saw a very significant decline in retail sales in April, or even to quite an extent overall in the second quarter of the year. And we have been seeing a recovery across these markets since then. Of course, the recovery levels significantly vary. So in the case of Vietnam, you can see that retail sales levels have already, or growth in retail sales has already increased to positive territory, allowing it to now cross pre-COVID levels and for it to continue growing beyond that. Whereas most other countries, even though it has been several months, even though lockdown restrictions have been eased, retail activities being relatively slow to recover. And that's because the COVID-19 outbreaks, as well as the lockdown restrictions that were put in place, have had a significant impact on consumer sentiment, on unemployment levels, and also income levels. And all of those are going to take relatively longer to recover. And they're going to take particularly longer to recover in the case of Indonesia, Thailand, and the Philippines. In the case of Indonesia and the Philippines, it's largely because of continuously rising cases. But in the case of Thailand, it is because a huge section of the economy is dependent on trade and tourism. And since both of those drivers have been quite significantly affected, there has been a particular spike in unemployment rates overall in the country, largely driven because of very large unemployment levels and reduction in income levels in those sectors. Of course, government support has been helpful in this case, which has provided some boost to that recovery in consumer spending activity, but it is unlikely to really be enough to compensate for that significant increase in unemployment levels and the reduction in income levels. Similarly, when we look at the overall manufacturing levels across the 5 Southeast Asian countries, we can see that there was this very significant dip in the PMI numbers in April. And soon after that, different countries started recovering at various different rates. Now, how we look at manufacturing purchasing managers index is that the level of 50 indicates or separates the expansion from contraction. So any number above 50 indicates an expansion in manufacturing activity, whereas any level below 50 indicates a contraction in manufacturing activity. What you'll notice here is that while all countries began recovering from about the month of May, now when we are coming closer to Q3, there has been this large variation where countries are swiveling between expansion and contraction. What this indicates is that while the recovery process has started, it is expected to be very gradual, where the overall recovery might fluctuate on a month-to-month basis from expansionary territory to contractionary territory. And so the overall recoveries to pre-COVID levels is going to still take a pretty significant amount of time, as overall manufacturing activity only recovers gradually over time. Now, this is where we wanted to pause and ask the audience a question. And so we would, if you could just use your screen to answer the poll that we have on the screen at this point in time, which is which of the 5 ASEAN countries present the greatest opportunities for your business in 2021, given the various different rates of COVID-19 infections, as well as recovery rates and GDP growth levels, various different rates of recovery in terms of manufacturing activity and consumer spending. Countries provide very varying levels of opportunity in this region. And so once again, to highlight, the question here is, which of the ASEAN 5 countries present the greatest opportunities for your business in 2021? We let the poll open for about 30 to 40 more seconds to get as many responses as possible before we continue on with the presentation. Great, so we have the poll results here ready, and we can very clearly see that Vietnam is what stands out when it comes to presenting the greatest opportunity. And this isn't something that is unique just to 2020 or 2021. We conducted a very similar poll about a year back, and we got very similar results where we saw Vietnam standing out as the country presenting the greatest opportunity. It's surely the country which is showing the lowest level of health risks or any operational risks related to COVID-19 because of their very efficient containment. And also economic output levels are expected to rise much faster than what we see across most of the Southeast Asian countries. So surely a major source of opportunity for multinational companies at this point. Now, going forward from the polling results, another major thing that is really going to drive an economic recovery, which is going to support economies during this time, is going to be government support. And so what we have here is some information or some data on the fiscal stimulus packages announced by various different Southeast Asian governments. What you'll see here is that we have split up the overall fiscal stimulus packages into above the line measures, which basically means the actual amount of money that is being spent as a part of these fiscal stimulus packages. So it's either the amount of money spent or any foregone revenue in terms of reduction in tax levels. And the second is liquidity support. And this is more related to things such as a reduction in interest rates or uh, allowing for a delay in payments of debt, for example. And so what we see here is that Malaysia had the overall largest fiscal stimulus package, and hence providing a lot of support to companies and individuals during this pandemic, especially given the fact that Malaysia was one of the countries that had one of the strictest lockdown restrictions, which spanned nationwide. But the country which is really spending the largest amount of money on the ground, providing the most cash support to businesses and uh, consumers, is Thailand, where you can see that the above the line measures is quite significant. Now, if we look across these countries, what we expect is these fiscal stimulus measures to still remain quite significant. We expect overall government budgets to either be maintained at the level seen in 2020 when we enter 2021, or we even expect an expansion and increase in the already high government spending levels next year. And as a result, government spending will be a strong support for the overall economic recovery across most of these countries and will be very important. Just one thing to note here, though, is that while the size of some of these fiscal stimulus packages can be quite significant, it is important to monitor how much of it is actually dispersed into the economy. And this is particularly an issue in the case of Indonesia, where at this point in time, the government has dispersed somewhere close to 40% of its overall fiscal stimulus package. As a result, the businesses and consumers on the ground are not really experiencing the benefits that were promised to them from these fiscal stimulus packages. While we expect disbursement rates to increase in Indonesia gradually, it is still going to be a limiting factor when it comes to government spending levels, uh, at least for the rest of 2020 and the beginning of 2021. So that is also another major thing to keep track across these markets. And once again, particularly in the case of Indonesia, if you're looking for greater government support amid the COVID-19 outbreaks. Apart from just providing support, another major move by a lot of governments is to really open up trade and use trade as a potential support for economic recovery, particularly in 2021. A big part of that is the implementation of RCEP, or the Regional Comprehensive and Economic Trade Partnership. Now, this is an agreement between originally 16 member countries based in the Asia Pacific region, which included the 10 ASEAN countries and also other Asian or APAC countries such as Australia, New Zealand, Japan, South Korea, India, and China. What happened last year is that India decided to withdraw from the agreement, and given following some recent meetings that have taken place between the rest of the member countries, sometime earlier this year, the countries have decided to go ahead with the agreement and sign, despite India having withdrawn from the overall agreement. What we expect as a result is that for this agreement to be signed in November of this year, and then for it to be ratified and implemented sometime about 1 year after that. Now, for sure, this is not something that has been confirmed, and there is a certain level of uncertainty in this. The main source of uncertainty comes from Japan, which has been against the idea of signing the agreement without India. But what it seems like at this point in time is that Japan is working on developing another free trade agreement along with Australia and New Zealand with India, while at the same time signing the RCEP next month. What we can expect if the RCEP is signed and then implemented the following year is that there are unlikely to be significant reductions in tariff levels, particularly when we compare to tariff levels uh, in relation to the ASEAN countries, because ASEAN countries already have free trade agreements with all of the other member countries. But what we can expect is a simplification of some slight reductions in tariffs and major simplification of custom requirements and administrative procedures. And so any companies which have their supply chains deeply rooted in the Asia Pacific countries or in these member countries will see a lot of benefit when it comes to import and export of raw materials, intermediate goods, and also their final goods within these member countries. It could reduce costs and also reduce the amount of time that it takes when it comes to fulfilling some of these custom requirements and administrative procedures. So this could provide some significant benefits to a lot of companies that have significant presence in the Southeast Asian countries, as well as the 5 other member countries. Apart from developments on the overall regional level, there are also significant political developments taking place in most of the Southeast Asian countries that will be critical for companies to be aware of as they enter 2021. A major one in the case of Thailand is the growing protests in the country against the current government as well as the monarchy. What we are seeing is an escalation of overall protests combined with a change in the military leadership. This is creating an environment for a potential military coup like the one that we saw in several times, dozens of times in the past several decades. This could create significant temporary disruption to business activity, particularly in the area of Bangkok, and could also dampen overall investment sentiment levels, and for a relatively shorter period of time, but still significantly dampen consumer sentiment. This would have a very significant impact on the Thai economy, as it is already suffering this due to the COVID-19 outbreaks and the fact that the flow of tourists has significantly reduced in the country. Now, while this event still remains improbable, the risk of a military coup is increasing and something that would be important for companies to prepare contingency plans for, and they can do so by referring back to their experience during previous coups in the country. Malaysia is also experiencing significant political uncertainty, driven by the fact that the current parliament is highly fragmented and a lot of different political factions are currently vying for power. It's a relatively more complicated situation, and so we would like to expand on that a little bit more when we do a deeper dive into this specific trend in Malaysia. Vietnam is experiencing some political risks or some political developments when it comes to its relation with the US. The Trump administration is launching an investigation into trade practices of Vietnam and is faulting the country for currency practices. This is the same or a similar investigation that the US launched against China before it implemented the significant tariffs on Chinese exports to the US. Now, as a result of this investigation, there is a potential for significant tariffs being put in place on Vietnamese exports to the US as well. Any decision on these potential tariffs will likely be taken following the upcoming US general election, and so that will be a major deciding factor in terms of future tariffs. It is for sure a major risk for Vietnam because Vietnam is ultimately or positions itself as a low-cost export hub. And if significant tariffs are imposed on the broad range of Vietnamese exports, that could really affect the cost effectiveness of Vietnamese exports and could reduce its overall investment attractiveness. In the case of Indonesia, the Widodo administration is facing backlash for the passage of its omnibus bills. And we'll go into detail of those omnibus bills in just a few slides. But any continued protests could result in a delay in the implementation of those bills and could also result in some slight modifications made to the bill before they're actually implemented. Now, we would like to pause here once again and to ask a very similar question to the one that we asked previously. But in this case, we want to focus in on the risks across these 5 Southeast Asian countries. And so the question posed to the audience is, which of the ASEAN 5 countries present the greatest risk for your business in 2021? Once again, we leave the poll open for about a minute to get as many responses as possible. Great. So we have the polling results in, and what we can very clearly see here is that Thailand seems to be the country with the highest level of potential risk. Now, this, of course, I believe would be very significantly linked to the overall level of political uncertainty taking place in the country, as well as given the fact that there is a lot of uncertainty in terms of any recovery in tourism levels, which tends to be a major driver for overall businesses, particularly those facing consumers. As a result, Thailand does stand out as a particularly risky country or a risky economy as we enter 2021. Indonesia also seems quite high up on the overall ranking with 31% of the votes. And once again, we believe that would largely be linked to the continuously rising cases in Indonesia, combined with the fact that the government does not seem to be very willing to implement significant containment measures to really reduce that health risk that stems from rising COVID-19 cases. There are, of course, major reports of the number of cases being significantly underreported in the case of Indonesia, how limited testing rates are restricting the number of cases that are actually presented in the official data. And that increases the overall risk levels even further because the outbreak is expected to be much larger than it is at this point in time. And as a result, it will likely take Indonesia quite a while to recover to pre-COVID levels due to the very significant health risks present in the country. And that brings us to the end of our section on the ASEAN regional outlook. What we would like to do now is to do some slight deeper dives into specific countries within Southeast Asia, focusing on certain specific trends which are more unique to these individual countries. We would like to start off alphabetically with Indonesia, and particularly focusing on some measures that the Indonesian government has implemented as a result of, or in an effort to improve the country's business environment, because Jokowi or Joko Widodo, the current president of the country, has always had a pretty big focus on attracting increased investment into the country. And improving the business environment has been, and also focusing on infrastructure, both of these combined have been the main drivers or the main changes that he's been looking to make to be able to achieve that goal of significant increase in investment, particularly foreign direct investment. Now, during his first term in office, what Jokowi did was that he implemented a number of policy reform packages that focused on more ad hoc measures of improving the business environment by doing things such as cutting red tape, creating an online system for business registration and administrative procedures, and various other measures. Once Jokowi was re-elected last year with a larger mandate, with more support in the parliament, as well as greater support from the overall electorate, Jokowi made made a decision to actually try to implement significant policy changes all at in a relatively short period of time to really give the investment, the business environment a significant boost in Indonesia. One of the ways he was looking to do this is by something called an omnibus bill on job creation. This bill on job creation is a bill that combines various different amendments within just one single bill in an effort to make drastic or pretty significant changes which would help improve the overall business environment. These measures include initiatives or policy amendments in the area of labor reform, a stronger central government, because that tends to be a major challenge for a lot of companies where decentralization within the Indonesian political system creates challenges when it comes to investment or really spreading out operations across various different provinces in Indonesia. Furthermore, the government and Jokowi were looking to also relax investment restrictions, where they're looking to increase the amount of foreign ownership allowed in various different sectors that were previously protected by the Indonesian government. They're looking at new business licensing regimes, which would make it easier for companies to obtain business licenses and make it relatively faster for them to obtain those licenses so they can start business operations faster. And also the relaxation of environmental standards. And this is particularly important for the construction and real estate industries. Now, as highlighted in the previous chart, the government has faced quite a bit of backlash because of the passage of these policies, particularly because of the changes in the labor policies and the environmental standards. And these protests continue even at this point in time amid rising COVID-19 cases in Indonesia. What we expect is that this will delay the implementation of some of these specific policies, particularly the ones related to labor policies and environmental standards. And what it might also result in is slight modifications to policies. So while the government was looking to make pretty significant changes, previously they might have to make certain small changes which could reduce the effectiveness of certain specific amendments that the government has proposed. However, despite that delay and despite any possible modifications, we expect this omnibus bill to be implemented over time and for this to provide a significant boost to the overall business environment. The Indonesian economy has been experiencing a gradual improvement in its overall business environment for the past several years now, but these specific measures targeted at very key points which multinational companies have complained about previously are likely to really improve its overall investment attractiveness. One of the other things that the government is also doing, and this was part of the government's other omnibus bill on taxation, is that it's significantly cutting down its corporate taxes. What you can see here is that the Southeast Asian countries often compete against each other to attract as much investment as possible. And in this competitiveness, Indonesia is looking to reduce its corporate taxes to be more in line with some of the more competitive countries such as Thailand and Vietnam. They've planned a gradual reduction where tax rates go down to 22% this year, and then a gradual reduction to 20% by the year of 2022. Now, this will provide support to any companies which have a direct presence in Indonesia, while also providing support to distributors for companies who work indirectly with distribution partners in the country, because they will now be experiencing lower tax costs. In terms of a recovery being driven by the government itself directly in 2021, as highlighted before, the government is looking to maintain its relatively high levels of spending next year when we compare it to the level of spending this year. So what you'll note here is that the government has had to significantly increase its overall spending in 2020 compared to 2019 as a result of the COVID-19 outbreaks. And the government is looking to maintain that high level of spending in 2021. There are surely some changes in government priorities that can be clearly noted when we look at this chart here. one of the major changes is the increase in spending on infrastructure development. The government hasn't just increased infrastructure development budget compared to 2020, but has increased it even further compared to the 2019 budget. What we expect as a result is for the government to really focus on infrastructure development as a source of economic recovery and to boost employment levels. The government will be focusing on its major priority projects that it has highlighted several times in the past several years, and also focus on more smaller scale rural projects, because those will provide more rural employment, which are important to support the economy and support low-income individuals at this point in time. Some areas which will see a slight reduction are areas such as social protection and also healthcare spending, which will see moderate levels of reduction but levels will still be maintained or still be higher compared to in 2019, but lower than 2020 when the government had to boost those budgets, particularly to be able to contain the virus or the significant outbreaks during this year. In the case of Malaysia, we would like to focus on the increasing level of political uncertainty that was highlighted before. What we have here is a chart that shows the composition of the Malaysia's House of Representatives and who various different or what various different members of parliament support at this point in time. Now, one thing to highlight here is that these are just rough numbers. There is no certainty in the support for individuals, but it does provide a good picture of how fragmented the overall parliament and the overall government in Malaysia is at this point in time. You'll see that the opposition is composed of a mix of supporters of Anwar Ibrahim as well as Mahathir Mohamad, whereas the ruling government includes supporters of the current Prime Minister as well as the former Prime Minister Najib Razak. What is happening as a result is that since various different political figures and political factions seem to be in a position to be able to get majority power, they're vying for the role of the prime minister. And so there are various different meetings with the Malaysian king, who ultimately makes decisions on things like elections and appointing any new leaders of the country, as various different individuals try to get hold of the leadership. This significant fragmentation in the government is creating a number of issues. One of them is that it is making it difficult for the government or the current prime minister to really pass any policies. And this is something that is likely to continue because the current prime minister does not have enough or significant enough power in the government. What is happening as a result is that any proposed policy is facing a lot of opposition, and that is going to slow down overall policy making in the country. What it's also resulting in is that it's increasing the chances of a snap election in the coming quarters or in the coming months. A snap election may result in a very significant change in the overall political dynamic in the country, could change government priorities. And so as a result, any B2G company or any company that is significantly dependent on government policies for their 2021 plans will need to be resilient and will need to be prepared for some significant changes in political agendas and overall composition of Malaysia's House of Representatives because of potential elections taking place in the coming quarters. So some major risks to be mindful of as we enter 2021. In the case of the Philippines, we would like to focus largely on the issue of consumer fear levels and how that is impacting consumer spending in the country. What we have here is survey results for a survey that is conducted on a very consistent basis. And the question posed to the respondents was, how often have you avoided going to shops to protect yourself or others from COVID-19? And what you can see here is that the Philippines stands out significantly in terms of consumer fear levels, where the significant proportion of them, or a relatively larger proportion of the respondents, stated that they are avoiding going to shops always or frequently to protect themselves or others from COVID-19. And as a result, we expect this to have an impact on overall consumer spending levels going forward. What we are seeing is consumer fear levels are reducing undoubtedly over time, even in the case of the Philippines, but the reduction is very slow and very gradual. And as a result, this overall high consumer fear levels will restrict any retail spending and any spending at physical stores. E-commerce is likely to, as a result, become increasingly important in most of these countries and also particularly the Philippines. One thing to highlight here also is that this is not just specific to consumer fear levels, but is also something that can be extended to patient fear levels. Healthcare companies will experience a reduction in any elective procedures taking place across these countries. And once again, particularly in the case of the Philippines, as individuals are avoiding going to any hospitals or healthcare facilities to protect themselves or others from COVID-19. So that also remains a major risk, not just for B2C companies, but also for healthcare companies in the Philippines. In the case of Thailand, we are seeing a relatively slow recovery in overall manufacturing activity. Now, this is being driven by a number of different factors. On one side, Thailand is quite dependent on exports as a source of revenue, and and as a result, a reduction in overall export demand is preventing the quick recovery in manufacturing activity. But a bigger factor here is a more significant buildup of inventories over the last couple of years in Thailand. So what you'll see here is that we have two indices on this chart, the production index and the inventory index. The production index tracks the growth in overall production levels in the country, and the inventory index tracks the growth in inventory levels. Any level above 100 represents an expansion, whereas any level below 100 represents a contraction. Now, as you'll see here, the inventory index has been majorly in expansionary territory, at least since the beginning of 2019. But if we extend this chart even further back, the inventory levels have been expanding in Thailand for several years now. What's happening as a result is that at this point in time, as demand gradually starts to recover, companies will now need to clear out their inventory before they can really start significantly increasing their manufacturing activity. As inventory levels continues to expand right now and remain at significant levels, this is going to restrict the increase in manufacturing activity for several months or even quarters as we enter 2021. This is reflected in the production index that we see here. It is reflected also in the PMI index that we showed previously, and is concentrated in and is an issue that we see across several sectors, including automotive, construction, and durable products. This is a major fact to keep in mind for manufacturing companies, as this can have a significant impact on your financial performance and the recovery of your financial performance in Thailand. And switching over to a trend for B2C companies and focusing on tourism, as that remains a very major driver for the Thai economy. What we show here is that the international travel and tourism industry contributes very significantly to the Thai economy, a much larger contribution than any of the 5 other emerging markets in Southeast Asia. Now, due to the travel restrictions put in place right now, this industry has come to a practical standstill and is having a pretty significant impact on the sector, of course, but is also having a very significant impact on the overall economy. Now, due to the significance of the sector, the Thai government is trying to plan a recovery of this industry. One of the ways it is doing so is by promoting domestic tourism. However, just given the significant size of the international tourism industry, which attracts more than 30 million people into Thailand every single year, the domestic tourism is unlikely to be anywhere close to enough to compensate for the halt in international tourism. What the government is also trying is it's trying to open up its borders to long-term tourists entering the country. The plan was to accept the first round of tourists coming into the country today, in fact, but the government had to delay its overall plan because of certain administrative procedures. As a result, what we can see is that it is taking much longer than even the government anticipated to really open up the economy. The government also plans to open up its tourism sector to to China by the 1st of January, but that is once again something that is likely to take longer than the government expects. And even once any restrictions are eased, the inflow of tourists is likely to be relatively low because of continued restrictions, because of continued health risks, all of which are going to prevent any significant amount of tourists from entering the country. And as a result, the domestic tourism industry will likely suffer, and any B2C companies that are really focused on catering to tourists are likely to continue to experience financial pressure even as we enter 2021. And finally, in the case of Vietnam, we wanted to highlight a major source of opportunity where Vietnam is attracting increased level of investment, even amid the COVID-19 outbreaks. And one of the major sources of investments is Japanese companies. What the Japanese government is doing is that it is subsidizing companies for them to move their supply chains or manufacturing activity out of China and into other countries. While the majority of the companies that are making use of this subsidy are relocating back to Japan, the second most favored destination outside of Japan is Vietnam. And as a result, Vietnam is expected to see significant investment coming in from Japanese companies that are making use of their subsidies to really expand their presence outside of China and increase manufacturing in other countries such as Vietnam. At this point in time, at least when it comes to the first round of subsidies, the majority of the companies relocating the manufacturing to Vietnam are healthcare companies. But as second and third round of subsidies really are being released, we expect an expansion in an increase in the number of industries that are then looking to enter Vietnam. Apart from just this specific situation, something that we saw as a continuation of a trend from last year, we are seeing several companies relocate to Vietnam as a result of the continued US-China trade tensions. So that is also something that is attracting investment into Vietnam and is likely to continue supporting overall investment growth in the country, and will also support an increase in overall investment. This brings us to the end of our presentation for today. Now, as for the final section, I'd like to pass over to Yu Chen to just ask some of the questions that we have received from the group till now.
Thank you, Ashu. Fantastic. Those are really good insights. So before we begin with the Q&A, just as a quick reminder, you can submit questions by clicking on the Q&A box of the GoToWebinar application on the right-hand side of your screen, and by typing them to Jakarta Frontier Webinars. So I see that we have a few questions coming during the presentation. Perhaps we can begin with some of those. So Ashu, the first question that I see, what is your outlook for the Southeast Asia currencies in 2021?
Right. Yeah, that's a great question, and something that is critical for most companies operating in Southeast Asia, because several companies do tend to import their products into the Southeast Asian countries rather than actually manufacture them within those markets themselves. What we expect for most countries in Southeast Asia is for the currencies to depreciate next year, with a few exceptions. So in the case of Indonesia, we expect continued depreciation as a result of the twin deficits. The Indonesian government is likely to continue having, or Indonesia is likely to continue having, a deficit in its fiscal budget, as as its current account, as well as its current account. And as a result, it's going to maintain that twin deficits, which is going to put downward pressure on the currency. Thailand is likely to experience continued depreciation because a halt in tourism or significantly lower tourism levels is also going to affect consumer or the current account surplus of Thailand, which will then put downward pressure on the overall currency or the Thai baht. In the case of the Philippines, also we are expecting continued depreciation, and that's largely because we expect a resumption in infrastructure development in the country. So what we've seen in the case of the Philippines is that as a result of the government's significant infrastructure development drive a couple of years back, the government was importing a lot of capital goods and capital equipment. That significant imports put a lot of pressure on the Philippine peso. What we see going forward is that, or at this point in time, a lot of that infrastructure development activity had been halted. And as a result, no capital or very little capital goods were actually being imported into the country. As a result, the currency started appreciating in 2020. In 2021, as the government starts developing its infrastructure once again and starts importing more capital goods, we expect that to start putting pressure on the Philippine peso and for the Philippine peso to depreciate. In the case of the Malaysian ringgit, it is one of the currencies that we expect to appreciate, supported by a rapidly recovering economy, combined with the fact that oil prices are expected to recover moderately next year. And the Vietnamese dong usually tends to be quite stable against the USD, and we expect that to continue next year.
All right, fantastic, Ashu. So the next question, are there any plans for travel bubbles in the ASEAN countries?
Right, that's a great question. At this point in time, several countries in Southeast Asia are still experiencing very major outbreaks, and so opening up to travel is not a part of their priority plans right now, especially when it comes to countries such as Indonesia and the Philippines. Thailand is the main country that is looking to open up its country, at least for the purpose of medical tourists, businesses, and also particularly tourism. So when it comes to countries opening up for tourism, Thailand is really the main country that is looking to open up. The other country that we see opening up for business travel specifically is expected to be Vietnam. It has already opened up to some countries such as China and Japan, and it is planning even more travel routes and more easing of travel with Japan, as it sees Japan a major source of overall economic growth. And so we can expect basically some positive developments in terms of travel bubbles and easing travel restrictions in Thailand, as well as Vietnam, while most other countries are likely to still keep their borders closed for at least the coming few months and quarters.
Thanks, Ashu. And I guess we just have time for one last question. The question would be, how long do you expect it to take for consumer fear level in the Philippines to normalize?
Right. It's a great question, and it is something that is really hard to predict. As we saw, Philippines has the highest consumer fear levels in the Philippines and in the region, and that will continue to impact overall consumer spending levels. And we are seeing some gradual reduction in overall consumer fear in the country. But just given the fact that the number of cases continue to rise in the country, we do expect it to take quite a while for consumer fear levels to come down. And as a result, we are expecting Philippines to experience one of the slowest recoveries in consumer spending when we compare consumer spending levels across the 5 main Southeast Asian countries.
All right, great, fantastic. Thank you, Ashu, for the wonderful presentation today. I think we are at the top of our hour for the webinar for today. If there's any question that we were unable to answer on the line today, or we will be sure to follow up with responses through your client service manager, and everyone will also receive a recording of the presentation within 24 hours. And again, you can view these webinar materials and much more on our new mobile app, which is available for download right now on iOS and Android. For complimentary access to our suite of resources, including the data, dashboard tools, and market monitoring reports, please email us at info@darkerfrontier.com, and a member of our team will be in touch with you. Thank you everyone for joining us online today, and we look forward to speaking with you again soon. Take care.